The Bank of Japan is set to hike rates today, while Singapore looks set to ease. Political turmoil suppresses South Korean GDP growth, and inflows of migrants into New Zealand fall again. That's coming up in our 5 Things in 5 Minutes. And then in today's bonus deep dive interview, ANZ Economist Krystal Tan analyses Bank Indonesia's shift away from being concerned about a weak currency towards wanting to stimulate GDP growth, leading to last week's surprise rate cut.
Growth is now rising in priority, and the central bank is basically signaling a desire to boost growth and a willingness to accept some currency weakness as a price.
But first, in 5 and 5 with ANZ, global markets were mixed overnight and remain on tenterhooks for more Trump policies on tariffs and migration. The US 10-year Treasury yield rose 4 basis points to 4.65%, and the S&P 500 was up 0.1% by 4 a.m. Sydney-Melbourne time, while the US dollar index was flat. Today, though, all eyes are on the Bank of Japan. ANZ FX analyst Felix Ryan and the market are expecting a 25 basis point rate hike to 0.5%.
We've had Governor Ueda say that he's quite pleased with the way some of the underlying economic data is evolving in Japan. In particular, there was note there around the wage pressures in Japan. So we did see the latest wage data from Japan show some quite strong figures there too. We also have the spring union wage negotiations there as well. And there's an expectation from the Bank of Japan that they'll be quite firm as well for this year too. We also are seeing in CPI data, that underlying service pressure looks like it's building quite strongly.
As of 4 a.m. Sydney-Melbourne time, the US dollar index was flat, but the Aussie dollar firmed 0.2% to 62.87 US cents, and the Kiwi was also up 0.2% at 56.76 US cents. Number 2. Ahead of the Bank of Japan's decision, the yen has been trading in a fairly tight range, sitting this morning at around 156 yen to the US dollar. Felix says any reaction in the currency will likely be because of future rates guidance.
It does come down to there being more evidence of more clear-cut discussion around further rate hikes in the future. And if we don't really see that materialise in any of the post-meeting commentary, then that will make it quite hard for them to sustain any upward move. At the moment, markets are pricing a hike by the Bank of Japan for this week, basically 100%. So it's fully priced.
Number 3. South Korea recorded weaker-than-expected GDP growth of just 0.1% in the December quarter. ANZ Economist Krystal Tan says while exports expanded due to strength in semiconductor demand, domestic consumption was a drag.
Domestic demand did weaken amid the political instability that was sparked by President Yoon's failed attempt at martial law. Private consumption, government spending, facility investments, all these expanded at a slower pace. And at the same time, construction investment remained a key drag. The weak GDP outturn does strengthen the case for the Bank of Korea to ease monetary policy settings sooner rather than later. So we do expect a 25 basis point rate cut in its next meeting in February, and then followed by another 25 basis point reduction in the second quarter.
Number 4. Singapore's headline annual inflation held steady at 1.6% in December, slightly above the consensus forecast. Attention now turns to the Monetary Authority of Singapore's policy review today. ANZ Head of Asia Research, Koon Goh, says falling core inflation, which fell from 1.9 to 1.8%, should allow the Monetary Authority to ease monetary policy slightly by lowering the slope of its policy band.
Now, despite the Singapore economy performing very well, GDP grew by 4% in 2024. The fall in core inflation is really what gives the MAS the policy space to undertake a preemptive easing of monetary policy. So with inflation well contained and risk to the growth outlook for 2025 pointed to the downside is why I expect the MAS to ease monetary policy in order to provide ongoing support to growth this year.
Number 5. New Zealand's net migration rate continued to fall in the year to November, with a new inflow of 30,600, well down from a peak of 135,700 in the year to October 2023. ANZ economist Henry Russell says the fall is due to a weak labour market and economy, which has caused fewer people to arrive and led more to leave.
In the year to November, 73,000 New Zealand citizens left the country. That's the highest on record, and close to 130,000 people in total left the country. Over half of those New Zealanders leaving were destined for Australia, and that's very much the pull of better job prospects and a labour market that's still fairly tight.
Henry Russell there. Now, in today's deep dive interview, ANZ Economist Krystal Tan dissects Bank Indonesia's surprise rate cut last week as it shifted concern from the currency to sluggish economic growth.
So based on growth and inflation dynamics, certainly there is a case for cuts, but the timing is what really caught the market by surprise. Because if we look at Bank Indonesia's past rate decisions, so it did cut in September. At that time, the dollar was soft, so the rupiah was doing well. But then Bank Indonesia then held its policy rate for 3 straight months in the fourth quarter. And the key reason was because they were prioritizing currency stability. So unlike other Asian central banks, for Bank Indonesia, currency stability is part of its primary mandate. So when the rupiah weakened during that period, Bank Indonesia held its policy rate. So given that dollar rupiah has continued to go up since then, in the year to date, it was widely expected that Bank Indonesia would continue to keep its policy rate on hold this month, but that wasn't the case. So this suggests that Bank Indonesia's priorities has now shifted. Growth is now rising in priority, and the central bank is basically signaling a desire to boost growth and a willingness to accept some currency weakness as a price.
Could you tell us then about the sensitivity of Indonesia's economy to those lower interest rates?
Yeah, so I think the efficacy of this moderate fall in the policy rate is going to be quite debatable. I think there are several reasons why we can expect the impact of this surprise cut on growth would probably be quite limited. Because first, on the demand side, if we look at what's happened with Indonesian households, so during the pandemic, they've had to draw down their savings. So now they're in that rebuilding phase. So it's not going to take like one cut or two cuts to really change the behavior. It's going to take significantly lower borrowing costs to entice them to step up spending. And I think it's a similar story for businesses as well. Against this backdrop of heightened global trade uncertainty, businesses are unlikely to raise investment just in response to a marginal fall in borrowing costs. And then we also have to consider on the supply side, right? If we look at what's happened with Indonesia historically, the pass-through to lending rates from earlier rate hikes was limited. And odds are that transmission is likely to be modest during the easing cycle as well. Look, so Bank Indonesia did deliver a 25 basis point cut last September. But since then, consumer loan rates have actually risen by 25 basis points. So that possibly reflected more cautious risk appetite given, that non-performing consumer loans are actually on the rise.
Why is that? It's quite noticeable that over the last couple of years, as the policy rate has increased, business lending rates haven't increased much.
Yeah, so Bank Indonesia has a multi-pronged approach to monetary policy. So what it's done in recent years is it's been raising its policy rate, but at the same time, to support growth, it's also implemented a range of macroprudential measures, basically incentives for the banking sector to make loans to priority sectors. So basically, in exchange for lending to certain sectors, banks are enjoying, cuts to their reserve requirement ratios. So that's helped keep lending rates low the past couple of years. Now, another aspect is that because of this multi-pronged approach BI has adopted when it comes to monetary policy, one of the things it's also done, it's introduced pro-market monetary instruments, right? Short-term rates that seek to basically both influence liquidity domestically and also attract portfolio inflows by having high rates. But one of the side effects of that is that because the rates are so attractive, domestic banks have also been interested in the instrument. And so that's basically taking up funds that could otherwise have gone to other areas, including loans.
Krystal Tan there. I'm Bernard Hickey. That was 5 and 5 with ANZ for Friday, January the 24th. Catch you next week as we look ahead to the US Federal Reserve's first rate decision of the year. And remember, we're not publishing on Monday, which is a public holiday in Australia. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.